Cava stock has been on a wild ride since its IPO, but is this fast casual darling the next Chipotle, or just another overpriced restaurant stock? The numbers are mixed. Cava is crushing it with new restaurant openings and strong profit margins, despite not fully scaling yet. However, recent same-store sale growth has slowed down, spooking some investors and causing a massive stock pullback in 2025. We'll be breaking down Cava, analyzing their plan to more than double their footprint to 1,000 locations, and determine if the stock drop is a buying opportunity for us or a sign of deeper problems. In the restaurant industry, anyone can grow revenue by adding stores. However, to determine if the brand has grown to support these new stores without cannibalization, we'll need to look at same restaurant sales growth year over year. Throughout 2024, Cava was accelerating their same-store sales with double-digit growth and accelerating from 14% growth to 21% growth at the end of Q4 2024, supporting the thesis that their fast casual Mediterranean concept has broad customer appeal and benefited with their brand perception of being a strong value compared to other fast casual and quick service restaurants. At a time when Starbucks was eliminating the third place vibe for people to comfortably hang out, Cava embraced the concept and launched Project Soul, make their restaurants more aesthetically welcoming. To no surprise, this double-digit and accelerating same restaurant sales growth propelled Cava stock to astronomical returns throughout 2024 with nearly 400% returns. In 2025, as the same-store sales growth accelerated, even though it's still positive, the stock price also plummeted. Needless to say, this metric is the single most important metric that will move Cava's stock price. The concern is that Cava may be struggling if they only have 2% same-store sales growth on Q2 2025. But for me, I understand the restaurant industry is tied to economic cycles, that there is less discretionary spending to eat out as household budgets tighten. With cyclical industries, it is best to buy the stock at the bottom of the cycle. Looking at competition for Q2 2025, and it is encouraging to see that Cava performed the best among fast casual competitors, with positive same-store growth, when Chipotle, Sweetgreen, and Wingstop all had negative. Now let's go through the second metric that's most important for restaurant stocks. It is restaurant-level profitability. Looking at the past year, in Cava's unit-level restaurant profit margins is mostly between 25 to 26%, which is incredible considering it's double the industry average for fast casual restaurants and super close to the 27% attained by gold standard Chipotle, despite having a much smaller footprint and scale to be able to negotiate costs against. For a company like Cava that is trying to grow their store count from 400 today to 1,000 by 2032, this is highly important, as Cava can fund the construction of new openings without being reliant on borrowing money or issuing new stock. It also means once a new restaurant is opened, each additional restaurant has a very high cash-on-cash return. Cava's management has done a superb job of preserving these margins in the face of current economic conditions of high inflation and rising labor costs. Now, 3 watchouts that we are going to be monitoring for an investment thesis in Cava are as follows. First, we just discussed these in detail, but we need to see same restaurant sales outperform the rest of the fast casual competitors and ideally get back to double digits. Restaurant level profit margins we want to see stay greater than 25% and hopefully even set the new gold standard above Chipotle. Second watch out is as Cava grows and opens new restaurants, they need to ensure food quality remains the highest priority, as having an E. coli outbreak, as has happened at Chipotle, will taint Cava's brand and cause the stock to plummet. Last watch out is monitoring Cava's store build-out to assess if their 1,000 stores by 2032 is on track. Cava is valued like a growth stock, so 10 to 15% same-store sales growth won't be enough. To outperform the S&P, we need growth accelerated with new store openings. Now let's look at Cava's valuation, run Cava through our framework to determine if we will add to our portfolio. Before we do, please read the disclaimer in the notes below. We are not financial advisors, and anything we say should not be taken as financial advice. Also, if you like content like this, please help us out and click subscribe as we aim to analyze the most long-term, innovative-focused companies twice per week. Now let's go over Cava's valuation. Even though Cava is generating tons of free cash flow and has a nice profit margin on a restaurant level, I have them here as still early on in its growth stage. Their primary growth in the next decade ahead will be in opening new locations and have publicly communicated their goal from having 400 locations today to 1,000 locations by 2032. This is about 15% growth in new locations each year for the next 7 years. To evaluate Cava, we'll put together a price-to-sales based valuation based on a projected outlook should they meet their 2032 target. So currently, Cava has made about $1.1 billion in revenue these past 12 months. Within these 7 years, let's assume same-store sales growth is 5% annually from now to 2032. This is higher than the 2% same-store sales growth today, but much lower than exceptional double-digit same-store sales growth in 2024. Assuming Cava does grow locations from 400 to 1,000 locations with minimal cannibalization from existing stores, new site openings will provide a 15% annual revenue growth. This means in total, Cava can have about 20% sales growth annually for the next 7 years, which is pretty incredible. As a cybersecurity leader, Palo Alto Networks is roughly around 10 to 15%. So with this revenue growth of 20% annually, let's be very strict and give a price to sales multiple of 5, as that is the multiple that Chipotle has been trading around when at steady state. Putting all this together gives Cava a $4 billion revenue run rate in 2032, which when tagged with 5 price to sales multiple is a market cap of about $20 billion or $171 a share. This is about a 15% annualized return from today's price, which does meet my target. So valuation does seem reasonable for a long-term hold if I believe Cava can hit that store count of 1,000 by 2032. Now let's go through the rest of my framework to determine if I want to add Cava to our portfolio. From a leadership perspective, I give Cava a strong. They are led by co-founder Brett Schulman and have a very strong board of directors with former Panera Bread's founder Ronald Schuck as the chairman. I give Cava a strong as do appreciate their methodical path to expansion by ensuring that they are able to self-fund new site openings from the cash flow from existing stores. Across the board, Cava's leadership team has done a phenomenal job these past few years for the key financial numbers, same-store sales growth, and restaurant-level profit margins. For valuation, I give Cava a strong. Assuming they have the 5% same-store sales growth on average, plus can get to the 1,000 stores in 7 years from the 400 store count today, the fundamentals do support a $20 billion market cap, which would meet my 15% annual target return. Revenue and profit growth I also have as a strong. 20% revenue growth for 7 years is really good, and in fact better than many tech companies. And I do like that their restaurant level profit margins are an incredible 26%, much higher than fast casual competitor, Sweetgreen, and approaching the margins of the much bigger Chipotle. For total addressable market, this is a strong. They only have 400 locations today, versus Chipotle has over 3,000. So as long as their brand remains strong, there are tons of opportunity for new store openings, which will accelerate their revenue growth. For secular tailwinds, I have this as a weak. Originally, the fast casual dining experience was a tailwind to be faster and cheaper than sit-down restaurants, but better quality than fast food. But the tailwind has been slowing down. Instead, the best tailwind I can think of is the growth in popularity of Mediterranean food as a healthy option. But taste preferences can change though, hence why I have tailwind as a weak. Overall, Cava may be an under-the-radar play that can beat the S&P. 20% annualized revenue growth and GAAP profitable at this scale is impressive. Even though it meets my valuation metric, I am a no to add to our long-term portfolio, as a lack of a strong secular tailwind is a deal breaker for me. What do you think, Dad, as you look at Cava?
Thank you, Scott, for that excellent evaluation of the company. Okay, for the company fundamental, it does not have a dividend. Cava does not have a dividend, and the beta is 2.5, which means it's basically 250% is volatile, more volatile than the S&P 500. The market cap is around 7 billion, and earnings comes out on November 11th. So I'm a neutral in that. For the earnings history, out of the last four, it beat 3 times out of 4, so that's a neutral to positive. For the financials, profit margin is 13%. It has no debt, and the PEG ratio is 3.2. So for financials, I give it a neutral because the PEG ratio is high. And then for the moving average, for the stock technicals, for the moving average, the price is below the 50-day, and the price is below the 200-day as well. And the 50-day is below the 200-day, which is not good either. So that's not good to be below the 250 days. So for the Bollinger Bands, it's very tight right now. The volatility, the price range is very tight. So I think it's going to get volatile pretty soon because it can't stay that tight. As you could see back a month or two ago, it was quite volatile. Slow stochastic oscillator is at a 54, which is neutral. MACD and unbalanced volume are a little bit positive. So for that, I give it a neutral to negative because of the moving average and the Bollinger Band being tight. I think it's going to become volatile soon. It's going to expand as to which direction nobody knows, but earnings don't come out until November 11th. So that's a factor. You know, whenever earnings comes out, things can get more volatile. Okay, for the last one, for the analyst coverage, there is one strong sell, one sell, 2 holds, 4 buys, and 2 strong buys. And institutions holding the stock is 79%, which means it's pretty good to be 79 to 80%. That dampens the volatility some. So that's a neutral to positive. So overall, I'm a no on this, Scott. It's just too far below the 50-day and 200-day. And as I said, I think the volatility is going to expand as to which direction nobody knows. But I'm a wait and see on this one. I'm a wait and see. I give it a few more weeks to see which way the volatility goes and such. So that's my take. So back to you, Scott.
Overall, we are both a no for Cava. My dad doesn't like the technicals right now, and for me, without a strong secular tailwind, I do not have confidence that they can grow at this rate without some cannibalization, and thus a hit on their profitability. With that said, thank you for watching. Please hit the like and subscribe button to keep up with our 2 times per week analyses on the best long-term innovative companies. Until next time, happy investing.